Welcome back to the Deep Dive. We've got the latest IMF Global Financial Stability Report here, the GFSR, and, well, the title itself tells quite a story. Shifting ground beneath the calm. It's quite the paradox right from the start.
It really is. It perfectly captures this weird moment we're in for global finance. Because, if you just glance around, things seem okay. Pretty tranquil, actually.
Yeah, financial conditions have definitely eased up since the April 2025 report.
They have. You've got less policy uncertainty floating around. Central banks are sounding a bit more accommodative, maybe signaling rate cuts down the line, and the U.S. dollar has weakened a touch.
And equity markets love that. We've seen them bounce back to record highs.
Yeah.
So superficially, things look pretty rosy.
Exactly. That's the calm part. But the IMF digs deeper, naturally. They use this framework called growth at risk.
Right, and we should probably explain that a bit for listeners. It's not just about predicting, say, a mild slowdown. This is statistical. It looks at the probability of really bad outcomes, the tail risks for economic growth.
Precisely. It quantifies the likelihood of severe downturns. And what their analysis is showing, despite the market highs, is that the actual risks to global financial stability, they remain elevated. Quite elevated, actually.
So the ground is shifting. Why? What are the big forces the IMF sees undermining this apparent calm?
Well, there are three main culprits they flag. First, asset valuations are stretched, really stretched, way beyond what the fundamentals seem to justify. Second, government debt keeps climbing, putting pressure on sovereign bond markets.
Okay.
And third, the financial system is getting more and more interconnected, especially between traditional banks and the non-bank financial sector, the NBFIs. And those connections increase the risk of shock spreading.
Got it. So that sets our mission for today's deep dive. We're going to unpack the IMF's view on these core vulnerabilities. That's mainly Chapter 1 of the report.
Right.
Then we'll tackle two really critical special topics the report zooms in on. Chapter 2 looks at hidden risks in the huge global foreign exchange market.
Which is absolutely vital for everything.
Absolutely.
Yeah.
And Chapter 3 examines the changing and frankly diverging landscape of emerging market sovereign debt. Some are doing okay, others not so much.
Yeah, it's a very split picture there.
So by the end of this, you, our listener, should have a really clear analytical shortcut to understanding the fault lines that are genuinely keeping global policymakers worried right now, despite the headlines. Okay, let's start with that first vulnerability, equity valuations. It feels like everyone's talking about how high markets are, and the GFSR confirms it. They point to the S&P 500's forward price-to-earnings ratio.
Yeah, the 12-month forward PE.
Right, and it's climbed back to around the 96th percentile of its historical range since 1990. I mean, that's incredibly high territory, historically speaking.
It is. It basically means the market is pricing in expectations for really fantastic, sustained profit growth for corporations going forward. Almost flawless execution, you could say.
But the IMF doesn't just take the market's word for it. They run their own models to estimate what they call fair value, right?
Yeah.
Trying to figure out what the market should be worth based on the underlying economy.
Exactly. They look at things like economic growth forecasts, interest rate levels, expected earnings quality, risk premiums, the whole macro picture to calculate a sort of fundamental anchor for the market.
And compared to that anchor, where are we now? How stretched do the models say we are?
The staff modeling suggests the current market valuation is stretched by about 10 percentage points above that estimated fair value.
10 percentage points. That doesn't sound trivial.
No, it's not. It's a significant gap. And the key implication, the thing you really need to grasp, is that it means the market has very little cushion, very little margin for error.
So if something goes wrong,
If any kind of adverse shock hits, maybe inflation proves stickier than expected and central banks have to reverse course, or a geopolitical flare-up gets worse, or maybe the economic growth story just disappoints, that 10-point gap means there's a much higher risk of a sudden, sharp, and potentially disorderly correction. The buffer just isn't there.
and what's particularly worrying, according to the report, is what's driving these high valuations. It's not a broad market rally.
Not at all. It's concentration. The risk concentration within the S&P 500, the IMF states pretty bluntly, is now at a historic high. It's actually higher than the levels we saw back during the peak of the dot-com bubble in 99 or 2000.
Wow. Higher than the dot-com bubble. That's a strong statement.
It is. And we need to understand how this whole run-up, almost all the gains recently, are being driven by this intense enthusiasm, bordering on euphoria sometimes, around a very narrow group of stocks, mostly information technology, and specifically artificial intelligence-related names.
The Magnificent Seven.
The M7, exactly. Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. Just those 7 companies, the IMF calculates, now account for a staggering 33% of the entire S&P 500 index by market cap.
Okay, but let's push back on the dot-com comparison slightly.
Yeah.
Back then, you had lots of companies with, frankly, questionable business models, zero profits, sometimes zero revenue, driving the market. The M7 are established giants, hugely profitable. Isn't the underlying quality different this time?
That's a fair point, and it's a key tension the IMF analysis explores. These are definitely real companies with real earnings, unlike many dot-com darlings. However, the risk the IMF focuses on isn't just the quality of the companies, it's the market's expectations and the resulting concentration. They look specifically at profit margin divergence.
Margin divergence, what does that mean?
It means that while analysts have been revising their future profit margin forecasts up for the M7, basically assuming these giants can maintain or even expand their profitability despite global headwinds, they've simultaneously been revising profit margins down for most other companies around the world. There's this huge split in expectations.
So the market is essentially betting that these 7 mega caps are almost immune to things like supply chain issues, rising costs, or geopolitical friction that might hurt everyone else.
That seems to be the bet baked into prices. The GFSR sees this as a sign of market complacency, particularly regarding potential impacts from, say, trade tariffs.
Right. Tariffs have been a growing theme. We've seen more targeted tariffs on crucial inputs, semiconductors, steel, advanced components. These are things needed to build the AI infrastructure, the data centers that power the M7 services.
Exactly.
How long can those M7 margins stay resilient if their key input costs start rising significantly due to tariffs?
That's the million-dollar question, or maybe trillion-dollar, given the valuations. The GFSR highlights this as a critical, potentially underappreciated risk. If tariffs really start to bite as a supply-side shock, increasing the cost of doing business even for these giants, then those optimistic margin forecasts for the M7 could reverse quite suddenly.
And because their valuations are built on this assumption of ever-expanding, super high profitability.
Even a small compression in their margins could trigger a major market re-rating. And given that these 7 stocks make up a third of the index, a correction in the M7 wouldn't just hit tech investors, it would pull the entire market down significantly. The concentration itself becomes the systemic risk. The whole structure is balanced on the performance of just a handful of firms, rising government debt, and pressure on sovereign bond markets.
Okay, so that's the equity market picture, stretched and concentrated. Now let's pivot to the other side of the balance sheet. Sovereign risk, government debt. The report notes that sovereign bond markets, like U.S. Treasuries, seem to have stabilized a bit after that tariff-related sell-off we saw earlier in the year.
Yeah, there was a period of calm after some initial volatility, but the IMF's message is, don't be fooled by the surface stability. The underlying structure, the ground beneath these critical markets, is actually on much shakier footing than it appears.
Shaky in what way? What are the warning signs they point to?
Well, they highlight a few technical but important indicators. We're seeing yield curves steepening again.
Meaning the gap between short-term and long-term government borrowing costs is widening.
Right. Which often signals market worries about future inflation, or, more relevant here perhaps, concerns about a large future supply of government bonds needing to be absorbed.
No.
They also point to more negative swap spreads persisting, and interestingly, a continued erosion of what's called the convenience yield on benchmark government bonds like treasuries.
Right, let's unpack those because they're a bit technical, but tell an important story.
Yeah.
Convenience yield, why is it important, and why is its erosion a bad sign?
Okay, so the convenience yield isn't a cash payment. It's the extra non-monetary benefit investors get from holding the safest, most liquid government bonds, primarily U.S. Treasuries. Think of it as a premium for their unique usefulness.
Useful as how?
They're the best collateral in financial transactions, they're essential for meeting certain regulatory requirements, and they act like a cash equivalent in times of stress. They're just convenient to hold.
Got it.
When that convenience yield starts to erode, it means investors are perceiving these bonds as slightly less special, less convenient. Maybe they're harder to source, maybe the market plumbing around them isn't working as smoothly, or maybe there's just such a massive supply of them that their scarcity value is diluted. It often points to stress or oversupply in the underlying market structure.
And negative swap spreads. That sounds weird. Why would a swap rate be lower than a treasury yield?
Yeah, it's counterintuitive. A swap spread is typically the difference between the fixed rate paid on an interest rate swap and the yield on a government bond of the same maturity. Normally, it's positive because there's some credit risk in the swap, When it turns negative, it usually signals some kind of distortion or
Sure.
stress. Often, it points to immense demand for the actual government bonds themselves, perhaps for collateral purposes, maybe driven by bank regulations or large-scale hedging by financial institutions. It can indicate funding stress or deleveraging pressures. While sometimes temporary, the persistence of negative swap spreads, combined with the steepening curves and falling convenience yields, strongly suggests the underlying cause the IMF is worried about.
Which is?
Expanding fiscal deficits, governments are borrowing more and more.
So investors are looking ahead at government spending plans, seeing rising debt levels, and basically saying, we need to be paid more to hold this long-term debt. That feeds into term premia, right?
Exactly. Term premia, that's the extra yield investors demand for the risk of holding a long-term bond compared to just rolling over short-term debt. The IMF finds a very strong connection, a clear co-movement between term premia and the projected average government budget balances over the next 5 years.
So future deficits are directly pushing up long-term borrowing costs now.
Yes, the market is anticipating the pressure. And then you have the other side of the equation, quantitative tightening, or QT.
Central banks aren't buying bonds anymore. They're letting their huge holdings shrink.
Right, the Fed, the ECB, others, they're stepping back. This increases the supply of bonds that the private market pension funds, insurance companies, asset managers, foreign investors has to absorb. These are price-sensitive investors, unlike the central bank.
So more supply from governments issuing new debt, and more supply hitting the market from central banks stepping back. It's a double whammy for supply.
It is. And this constant pressure from both fiscal deficits and QT is what keeps yields structurally higher. And critically, it creates this latent risk of forced liquidation in times of stress.
This is the scenario that sounds alarmingly like the market seizure we saw in March 2020. The fear that bond mutual funds facing big investor outflows, coupled with a sudden spike in interest rates, might be forced to sell even safe assets like treasuries.
That's the nightmare scenario the GFSR quantifies. They modeled an extreme but plausible stress event, combine a massive outflow from bond funds, something at the 99th percentile of historical outflows, with a sudden, sharp 100 basis point jump in interest rates across the board.
Okay, a real panic situation.
In that scenario, their estimate is that the forced selling of U.S. Treasuries alone by these funds could reach almost $300 billion.
$300 billion. That's a huge number. But hang on, didn't the Fed set up things like the Standing Repo Facility, the SRF, precisely to prevent this kind of treasury market breakdown after 2020? Isn't there a backstop now?
That's a really important question. Yes, the SRF exists, and it provides a crucial liquidity backstop for primary dealers and eligible banks. It allows them to swap treasuries for cash directly with the Fed.
So why is the IMF still sounding the alarm about $300 billion in forced sales?
Because the SRF helps the dealers, but the forced selling pressure originates primarily from non-bank entities like mutual funds facing redemptions. The issue is the intermediation capacity of the dealer system itself.
Meaning the dealer's ability to actually buy those treasuries from the selling funds, warehouse them, and then potentially repo them out via the SRF.
Exactly. The sheer size of the treasury market has grown enormously, and the scale of potential selling from the rapidly growing non-bank sector might simply overwhelm the dealer's ability to absorb it all smoothly, even with the SRF there. The plumbing could get clogged. That $300 billion figure represents a volume that could genuinely stress test the market's core infrastructure, potentially causing a freeze-up reminiscent of 2020, despite the new facilities. The system's capacity hasn't necessarily kept pace with the risks and risky interconnections, banks and NBFIs.
That plumbing issue, that capacity constraint, leads us perfectly into the third big vulnerability. The non-bank financial intermediary sector, the NBFIs, often called shadow banking. It's grown huge, hasn't it?
Massive. And systemically important. The GFSR pegs the NBFI sector at $239 trillion in assets globally in 2023. That's nearly half, 49.1% of total global financial assets.
Almost half the financial system is now outside the traditional, more heavily regulated banking sector.
Pretty much. And the key risk the IMF focuses on isn't just the size itself, but how deeply these NBFIs are now intertwined with the regulated banks, especially through funding relationships.
How deep is that connection? What kind of exposure do banks have?
Looking at banks in Europe and the U.S., the report estimates about $4.5 trillion in total exposure. That includes direct loans to NBFIs, but also, crucially, undrawn credit commitments.
Those are the lines of credit that NBFIs can tap basically whenever they want, especially if they get into trouble.
Exactly. They're a hidden source of liquidity demand on banks during stress, and the risk is concentrated. In the U.S. sample the IMF looked at, banks representing almost half of the total assets had NBFI exposures loans, plus those commitments that actually exceeded their Tier 1 capital.
Whoa, Tier 1 capital is the core safety buffer, right?
Hmm.
The highest quality capital banks hold to absorb losses. If NBFI exposure exceeds that buffer,
It means a significant problem within the NBFI sector. Maybe a wave of defaults in private credit funds or a run on money market funds could directly transmit major losses back to the banks, potentially eroding a large chunk of their core capital.
and is this risk spread evenly, or is it concentrated in certain types of banks?
It's concentrated. The IMF found this risk is particularly acute among the large regional banks, especially in the U.S. These interconnections mean stress travels fast. An NBFI faces margin calls or redemption pressures, it draws down its bank lines, and suddenly the stress is inside the regulated banking system.
So the IMF ran stress tests to see what this might look like in practice.
They did two key tests. First, they looked at solvency. They modeled a scenario that combined worsening credit quality at the NBFI's banks lend to, plus a full simultaneous drawdown of all those unused credit lines we just talked about.
Okay, a double hit. Credit losses and a liquidity drain. What was the impact on bank capital?
The result was a substantial depletion of bank capital. Specifically, common equity Tier 1 ratios, that core CET1 measure, would fall by over 100 basis points in about 10% of the U.S. banks sampled, and perhaps more worryingly, in 30% of the European banks.
A 100 basis point drop in CET1 is definitely serious.
Yeah.
That significantly increases the measured riskiness of those banks.
Yes.
What about the liquidity side? That often bites first in a crisis.
The liquidity test was arguably even more alarming. They looked at what happens if those NBFI borrowers just draw down all their credit lines fully, which, remember, they'd be highly incentivized to do in a panic to hoard cash.
Right.
In that scenario, the IMF estimates that up to 14% of U.S. banks, mostly the smaller and regional ones, and 5% of the large European banks could find themselves with negative net available liquidity.
Negative net available liquidity. Let's be crystal clear. What does that mean for a bank practically?
It means, quite simply, they wouldn't have enough readily available cash or easily sellable liquid assets on hand to meet all their immediate projected cash outflows, including those sudden draws from NBFIs.
So they'd be short of cash.
Yes. They'd immediately have to scramble, either borrow urgently in stressed funding markets, potentially sell other assets quickly at fire sale prices, which could spread contagion, or rely heavily on emergency borrowing from the central bank's discount window.
So the IMF is signaling a risk of acute, potentially widespread funding pressure hitting a significant minority of banks, triggered by stress originating entirely outside the banking system in the NBFI sector.
Precisely. These quiet, complex links between banks and non-banks are a major vulnerability hidden beneath the surface calm. The interconnectedness is the threat.
Okay, let's move on to the first of the GFSR's special deep dives. This one looks at the global foreign exchange market, the FX market. It's the biggest, most liquid market in the world, supposedly. But the report finds structural changes are making it potentially more fragile.
That's right. The FX market is obviously critical for everything, trade, investment, funding, but its structure is changing. One key shift is the growing role of NBFIs, again, and their increasing use of instruments like FX swaps, not just for hedging currency risk, but also for funding their operations.
FX swaps are huge, right? Can you remind us how they work and why NBFIs use them so much?
Sure. An FX swap basically involves exchanging one currency for another today, with an agreement to swap them back at a predetermined rate on a future date. NBFIs, like big global asset managers, pension funds, or hedge funds, use them extensively. One reason is simple hedging. If they hold assets in euros but their liabilities are in dollars, they use swaps to lock in the exchange rate.
Okay, that makes sense.
But the other big use, especially for non-U.S. entities, is synthetic U.S. dollar funding. They can use their local currency, swap it into dollars for a period, use those dollars for investments or operations, and then swap back later. It's a core part of the global dollar funding market, operating outside traditional bank loans.
Got it. So NBFIs are big players, using swaps for hedging and funding. How does this create fragility?
The fragility comes when you get shocks to macro-financial uncertainty. Think about sudden spikes in market volatility, like the VIX index for stock market volatility, or the MoVE index, which tracks bond market volatility.
When those spike, things get nervous.
Exactly. And the GFSR finds that NBFIs react much more sharply, much more disproportionately to these uncertainty shocks compared to banks.
How much more sharply?
The data is quite striking. When one of these uncertainty shocks hits, non-resident NBFIs, those operating across borders, tend to increase their FX trading volumes by about 40 percentage points.
40% jump in trading activity. Okay, what about banks?
Banks, in contrast, only increase their trading volumes by about 15 percentage points in response to the same shock.
Wow, that's a huge difference. NBFIs are trading almost 3 times more aggressively in response to volatility. Why?
It likely reflects their business models and constraints. Many NDFIs operate with higher leverage than banks. When volatility spikes, they might face immediate margin calls on their positions, forcing them to trade maybe unwind positions, maybe scramble for hedges.
So they have less wiggle room.
Less wiggle room, tighter liquidity constraints, maybe less access to stable funding compared to banks. They're closer to the edge, operationally. So market turbulence translates much more directly and immediately into forced trading activity for them.
And this sudden surge of trading activity from NBFIs, all potentially going the same way, that's what creates stress in the FX market itself.
Precisely. It can overwhelm market liquidity temporarily. And the IMF measures this stress using something called covered interest parity deviations, or CIP deviations.
Okay, CIP, let's define that. The theory is that you shouldn't be able to make a risk-free profit just by borrowing in one currency, swapping it to another, investing there, and swapping back. Right. The forward exchange rate should adjust to eliminate any arbitrage.
That's the theory of covered interest parity. The cost of borrowing dollars directly should be the same as borrowing, say, euros, and using an FX swap to turn them into dollars synthetically after accounting for the swap cost.
So when do deviations occur? When does the parity break down?
Deviations widen when they're stressed, particularly in dollar funding markets. If it suddenly becomes much more expensive or difficult to get dollars via the swap market compared to borrowing them directly, the CIP deviation widens. It's a very clean, direct signal of increased U.S. dollar funding stress globally. It means people are paying a premium to get their hands on dollars through swaps, signaling scarcity or fear.
And the GFSR makes the point that this isn't just some technical market anomaly. Widening CIP deviations, this FX market stress, actually feeds back into the broader economy.
Absolutely. It's not contained. The stress tightens overall financial conditions globally. It tends to push down risky asset prices, stocks, corporate bonds. The GFSR actually quantifies this feedback loop.
What do they find?
They estimate that a one standard deviation widening in these cross-currency bases, another term for CIP deviations, typically tightens overall financial conditions by somewhere between 0.4 and 0.7 standard deviations over the following year. That's a noticeable impact.
And is the impact the same everywhere?
No, and this is crucial. The impact is much worse for countries or institutions that have significant FX mismatches.
Meaning they have a lot of money in dollars but earn their income or hold their assets in their local currency.
Exactly. If you have large, unhedged dollar liabilities, then a spike in dollar funding stress, signaled by widening CIP deviations, can amplify the tightening of financial conditions in your economy by as much as 2 standard deviations. Your internal vulnerability magnifies the external shock.
That's a huge amplification effect. So if NBFIs are often the ones amplifying the initial volatility, and this creates dollar funding stress, what about the policy responses? The Fed famously activated and expanded its U.S. dollar swap lines with other central banks during the COVID crisis in 2020. Did that help?
Yes, and the GFSR provides really valuable empirical evidence on their effectiveness. This is critical for knowing if these tools actually work when needed.
What did the analysis show?
It showed they were highly effective. The activation and use of those Fed swap lines during the peak stress in 2020 reduced the CIP deviations by up to 30 basis points.
30 basis points. How significant is that?
That's substantial. It was enough to almost entirely offset the initial widening of the deviations caused by the spike in the VIX Uncertainty Index. It acted as a powerful circuit breaker, calming the dollar funding market and significantly stabilizing exchange rates.
So the takeaway is that in our highly interconnected, dollar-dominant financial system, these central bank liquidity backstops, particularly the Fed swap lines, are absolutely essential for global financial stability during crises.
They are fundamental. The stability of the whole architecture relies on the willingness and ability of key central banks, especially the Fed, to provide this dollar liquidity backstop when market functioning breaks down.
All right, let's move to the second special topic in the GFSR, which focuses on emerging market and developing economies, or EMDEs, specifically their sovereign debt. And the story here, as you hinted earlier, is one of sharp divergence, a real split.
It really is a tale of 2 or maybe even 3 different groups of countries. The key dividing line the IMF highlights is how these countries finance their government debt.
Okay, what's the main difference?
The major, more established emerging markets, think countries like Brazil, Mexico, India, Indonesia, South Africa, They've made huge strides over the past couple of decades in developing their local currency bond markets, LCBMs.
Meaning they issue debt denominated in their own currency, bought largely by domestic investors.
Exactly. And the report notes that these major EMs now finance, on average, over two-thirds of their government debt through these local markets. That's a massive structural shift.
And why is that considered such a big improvement for resilience?
Two main reasons. First, it drastically reduces currency mismatch risk. If you borrow in your own currency and your revenues, taxes are also in that currency, you don't face the risk of your debt suddenly ballooning if the exchange rate collapses. Second, it reduces rollover risk dependence on fickle foreign investors. Domestic investors are often more stable, so it acts as a significant shock absorber, insulating them somewhat from global financial turmoil.
Okay, so that's the success story for the large EMs. But the picture is very different for other EMs, and especially for the frontier markets, the FMs. These are generally smaller, lower income, less developed markets.
That's where the story gets much darker. These FMs and some of the smaller EMs still rely very heavily on borrowing in foreign currency, mostly US dollars or euros, typically by issuing euro bonds in international markets.
So they face exactly those currency mismatch and rollover risks that the bigger EMs have reduced.
Precisely. Any strengthening of the dollar or rise in global interest rates hits their debt servicing costs directly and immediately. And the report shows they are facing serious, ongoing refinancing pressure right now.
What does that pressure look like in practice?
Well, when they do manage to issue new bonds in the primary market, they're typically having to rely on shorter maturities, meaning they have to come back to market sooner, and the deal sizes are often smaller. These are clear signs that international investors are nervous and demanding higher compensation for the risk.
And what are the borrowing costs looking like for these countries?
They are alarmingly high. The GFSR notes that the median sovereign Eurobond yield for frontier markets is now exceeding 6.5%, and for several specific FM issuers, their bonds are trading with yields above 10%.
10% yields. That sounds close to distressed levels, suggesting the market sees a real risk of default.
It's definitely in the danger zone. And the most acute risk the IMF flags is the repayment calendar. Many frontier market issuers, particularly in sub-Saharan Africa, have large chunks of debt coming due for repayment in late 2025 and into early 2026.
So a refinancing wall is approaching.
A significant one. And given the current sky-high borrowing costs, rolling over that maturing debt without facing severe distress or potentially needing financial assistance from the IMF or other bodies is going to be extremely challenging for quite a few of these countries. The ground beneath them is structurally very unstable.
Okay, now let's circle back to the more resilient major EMs that rely on their local currency bond markets. The GFSR finds something interesting here about who holds the local debt. They say that having more resident investors, especially domestic banks, tends to dampen the transmission of global shocks, like a spike in the VIX.
Yeah, the empirical finding is that when domestic players, particularly banks, hold more of the government's local currency debt, the country's bond yields react less violently to global risk-off events compared to countries where non-resident investors dominate the local market.
That sounds good, right? Domestic banks acting as stabilizers.
It is good from the perspective of reducing volatility caused by external factors. Domestic banks are generally stickier investors. They're less likely to panic and dump bonds during a global sell-off compared to, say, international hedge funds.
But I sense a but coming.
There's a big but.
Oh.
While domestic banks might stabilize yields against external shocks, their heavy ownership of government debt massively strengthens a dangerous feedback loop known as the sovereign bank nexus.
The doom loop. We need to define this clearly. How does it work?
It's a potentially toxic two-way street. On one hand, if the government's perceived creditworthiness starts to wobble, maybe due to high deficits or slow growth, the value of the government bonds held by the domestic banks falls sharply. This directly erodes the bank's capital base, potentially making them insolvent or restricting their ability to lend.
Okay, so sick sovereign makes sick banks. What's the other direction?
If the banks get into trouble for any reason, maybe due to bad private loans or mismanagement, the government often feels compelled to step in and bail them out to prevent a wider financial crisis. But this bailout costs the government money, increasing its own debt burden and potentially weakening its own creditworthiness.
So sick banks make the sovereign sicker. It's a vicious cycle.
Exactly. The health of the banks and the health of the government become dangerously intertwined. They effectively become hostages to each other's fate.
And the IMF tried to quantify how dangerous this nexus is in these EMs.
They did. They ran a hypothetical stress test. What if local currency government bond prices suddenly fell by 40%? A severe but not impossible scenario in a
What is
crisis.
the result?
The result was stark. In more than half of the banking sectors across the sampled emerging and frontier markets, such a shock would cause them to fall below their minimum regulatory capital requirements, basically wiping out a huge chunk of the banking system's capital buffer.
Wow. Over half the banking systems would be potentially insolvent or close to it.
And to really hammer home how tight this linkage is, the GFSR notes that during periods of extreme market stress, the implied probability of the sovereign defaulting and the bank's expected default frequency, a market measure of bank risk, tend to move almost one for one. You simply cannot separate their fates when things get ugly.
That's a critical vulnerability hiding within the apparent stability of local currency borrowing. Okay, before we get to policy fixes, the GFSR introduces one more very modern dynamic into this sovereign debt picture: stablecoins.
Yeah, this is a fascinating forward-looking part of the analysis. Stablecoins, digital tokens like USDC or Tether that aim to maintain a stable value, usually pegged one-to-one with a major currency like the US dollar, have exploded in size.
And to maintain that peg, they need to hold reserve.
Exactly. They're typically required by regulation or market practice to hold reserves backing the coins in circulation. And overwhelmingly, those reserves are held in the form of very safe, very liquid assets, predominantly short-term government securities, especially U.S. Treasury bills.
So stablecoin issuers have become major buyers of T-bills and similar assets.
Huge buyers. They are now significant institutional players in the market for short-dated, high-quality government debt. An entirely new class of buyer has emerged relatively recently.
What are the financial stability risks the IMF sees emerging from this new dynamic?
They highlight two main potential risks. The first is a kind of digital age bank run risk, but applied to stablecoins.
Run on a stablecoin.
Yeah. If confidence in a major stablecoin issuer were to falter for some reason, maybe concerns about the quality of their reserves, or a hack or regulatory action, you could see a mass redemption event. Users rush to cash out their stablecoins back into traditional dollars.
And to meet those redemptions, the issuer would have to
Sell their reserve assets, those treasury bills, very quickly and potentially in very large volumes. This sudden, forced selling of safe assets by a major player could significantly disrupt the functioning of crucial short-term funding markets, like the T-bill market. It's a new potential source of systemic liquidity stress.
Okay, so forced selling is risk number one. What's the second?
The second risk is more gradual and structural, and it relates back to that sovereign bank nexus idea, actually. It's the risk of credit disintermediation.
Disintermediation, meaning bypassing the banks.
Essentially, yes. If stablecoins become increasingly popular and users start holding more of their transactional cash in stablecoin wallets instead of traditional bank deposits, then that potentially drains funding away from the banking system. Banks rely on deposits to fund their lending activities, especially longer-term loans like mortgages or business investment loans.
Right.
If that deposit base shrinks because money moves into stablecoins, which then buy T-bills, you could see a structural shift in demand away from bank funding and towards short-term government debt. This could potentially cause the yield curve to steepen persistently higher long-term rates relative to short-term rates. And more fundamentally, it could reduce the overall capacity of the banking system to provide credit to the real economy.
So, ironically, a shift towards a seemingly safer digital cash alternative held outside banks could inadvertently lead to tighter credit conditions for everyone else.
That's the potential long-term structural risk the IMF is flagging. The rise of stablecoins isn't just about crypto. It could reshape the fundamental plumbing of sovereign debt markets and bank funding in ways we're only beginning to understand.
So the GFSR lays out a pretty sobering picture. We have this surface calm, but underneath, you've got stretched equity valuations driven by concentration, shaky sovereign bond markets under pressure from debt and QT, deep and risky links between banks and NBFIs, plus new fragilities in FX markets and potential disruptions from stablecoins. It's a complex web of risks.
It really is. The shifting ground metaphor is apt.
Given all that, what's the IMF's prescription? What's the RX they're offering to policymakers to try and shore up stability and navigate this tricky period? Let's start with the big picture stuff: macro policy, fiscal discipline.
Right. On the monetary policy front, the message is caution and vigilance. Central banks need to remain really attentive to inflation risks. The report specifically mentions tariffs acting as a potential supply shock that could complicate things.
Meaning tariffs could push inflation up even if demand is weakening, making the central bank's job harder.
Exactly. So they need to be careful with any easing cycles, making sure they don't declare victory over inflation prematurely or inadvertently add more fuel to those already stretched asset valuations. And underpinning all of this, the GFSR absolutely stresses the critical importance of maintaining central bank operational independence to keep inflation expectations anchored. That's non-negotiable.
And on the fiscal side, addressing the root cause of that bond market pressure.
The message is pretty blunt. Urgent fiscal adjustments are needed in many countries to get debt trajectories back on a sustainable path. Credibility here is key. But it's not just about spending cuts or tax hikes. The IMF also pushes for structural improvements to make bond markets themselves more resilient.
Like what kind of structural fixes?
Two key technical ones stand out. First, expanding the use of central clearing for transactions in both cash government bonds and repurchase agreements, repos.
How does central clearing help?
It replaces bilateral counterparty risk with risk managed by a central counterparty, CCP. This reduces the fear of one firm's failure cascading through the system and also makes collateral use more efficient, freeing up scarce, high-quality assets like treasuries. Second, they advocate for robust standing liquidity facilities.
Like the Fed's SRF we discussed, making those emergency tools more permanent and reliable.
Essentially, yes. Having well-designed facilities that can quickly provide liquidity against good collateral during stress helps prevent market freezes and normalizes what had to be done on the fly back in 2020. It builds confidence in the market plumbing.
Okay, moving from macro policy to the sector that seems to worry the IMF most, the non-banks, NBFIs, and also touching on digital assets like stablecoins. What's the recommendation there?
For the sprawling NBFI sector, the first step is almost embarrassingly basic, but incredibly hard. Better data collection. We simply need a clearer picture of who owes what to whom, what the leverage levels are, and where the risk concentrations lie. This requires better reporting standards and, crucially, strong cross-border coordination among regulators because these firms operate globally.
So better visibility first, then what?
Then focus on mitigating the specific risks, especially liquidity risk. Policymakers need to actively implement and, where necessary, expand the use of liquidity management tools for investment funds.
Things like swing pricing. Can you quickly explain how that works again?
Sure. Swing pricing essentially adjusts the fund's net asset value, NAV, downward slightly when there are large outflows or upwards for inflows. The key is that the investors who are leaving the fund during stress bear the immediate transaction costs associated with selling assets to meet redemptions.
So it protects the remaining investors and reduces the incentive for everyone to rush for the exit first.
Exactly. It internalizes the externality of fire sales, making runs less likely. It's a crucial tool to prevent stampedes.
What about funds holding really illiquid stuff, like private credit or distressed debt, where even swing pricing might not be enough if everyone wants out?
For those types of assets, the IMF argues more definitive regulatory guidance is needed, potentially mandating longer redemption frequencies. If the underlying assets take weeks or months to sell fairly, the fund simply cannot offer daily or even weekly redemptions. The redemption terms have to match the liquidity of the assets held.
Makes sense. Aligning liquidity promises with reality.
Right. And specifically for those private credit funds that are increasingly being marketed to retail investors, the report calls for stringent requirements to manage liquidity and prevent the kind of herd redemption behavior that could destabilize markets. Finally, underpinning bank resilience, the IMF urges the full, timely, and consistent implementation of internationally agreed prudential standards, basically, finishing the job on Basel III to ensure banks have adequate capital and liquidity, especially given those growing links to the NBFI sector.
Okay, last area. Strengthening resilience in emerging markets and dealing with those FX market risks. What's the advice for EMDDs?
For the EMs and FMs themselves, the long-term game is still about strengthening their local currency bond markets. This means solid macroeconomic fundamentals, controlling inflation, sustainable fiscal policy, but also actively working to diversify the investor base within those local markets.
Specifically, trying not to rely too heavily on domestic banks to soak up all the government debt, avoiding that sovereign bank nexus.
Precisely. Encouraging pension funds, insurance companies, asset managers, and even retail participation in local bond markets makes them deeper and more resilient. On the FX market side, the recommendations focus on preparation and surveillance.
Really?
Enhance monitoring of FX exposures across the financial system. We need to know who is mismatched. Close the data gaps, especially regarding NBFIs, FX activities, and liquidity positions. Ensure banks and other financial institutions have adequate capital and liquidity buffers specifically calibrated to handle potential currency shocks.
And reinforcing the safety net.
Yes, absolutely. The report concludes by stressing, once again, the importance of strengthening the global financial safety net. This means countries maintaining sufficient international reserve buffers on their own, but also ensuring the adequacy and accessibility of resources from institutions like the IMF, and critically expanding and normalizing those central bank swap lines we discussed earlier so they can be deployed quickly and predictably to stabilize global funding markets when panic inevitably strikes again.
Well, we've certainly covered a lot of ground today, diving deep into the IMF's latest assessment. The core message seems clear. Don't be complacent about the current market calm. It feels fragile.
Definitely fragile. It's underpinned by these deep structural risks we've walked through, the stretched valuations in tech, the mounting pressure on government debt, the complex and growing interconnectedness between banks and non-banks, and the evolving risks in core markets like FX.
The GFSR really does provide that analytical roadmap, highlighting where policymakers need to focus their attention: fiscal discipline, smarter regulation for NBFIs, strengthening market infrastructure, reinforcing global safety nets.
And the underlying warning is that failing to address these structural issues proactively while things seem calm just increases the risk of a much more painful and disorderly correction down the road when the next shock inevitably hits. It could be triggered by any one of these vulnerabilities feeding on another.
Which brings us to our final provocative thought for you, our listener, something to mull over. We spent some time discussing the rise of stablecoins and how they've become major buyers of short-term government debt, particularly U.S. T-bills.
Right, a whole new player in that market.
Now, couple that observation with another finding. The IMF has noted previously that the unique convenience yield enjoyed by U.S. Treasuries, that extra benefit of holding the world's premier safe asset, has actually been on a slow, secular decline over the past decade or so. It suggests the dollar's special status might be subtly eroding at the margins.
An interesting convergence of trends.
So the question we want to leave you with is this. Given the rise of new digital asset players in sovereign debt markets and this slow erosion of the traditional convenience yield, are we perhaps witnessing the very beginning of a fundamental, maybe even permanent shift away from the U.S. dollar's absolute dominance as the preeminent global safe asset? And if that confidence continues to slowly chip away, what might the long-term geopolitical and financial consequences be?
A big question. Definitely something to think about as you try to navigate the shifting ground beneath the current calm.
Indeed. That's all for this deep dive. Until next time.